Well, hello there, my friends, and good morning here on Wednesday, the 21st at 11:09 a.m. Eastern Time, where in addition to gold absolutely soaring again, interesting, we have some divergence between gold and silver, but you've probably seen or heard or maybe looked maybe a bit more closely into how there's been a lot of unusual activity from the Fed in the past month or so, and of course, shockingly, the Fed hasn't really like come out and given a straight story and explained that. Although perhaps some things similar to what we saw in 2019. And fortunately, to break that down and also talk gold and silver, we'll get some economy talk because I hear things are slowing down from Punisher of the Coastal Journal. His parents know him as Greg Crennan, but as his Twitter tag, which we'll pull up later, he is official title is Punisher of Wall Street. And Punisher, it's great to have you back here. You punished recently, just a couple months ago, on some of the things that now we're seeing unfold with stunning gold and silver prices. In fact, Punisher, even before we get to the Fed, do you realize that the silver price is basically up 100% in the last 2 months?
Yeah, it is. Silver has gone on an incredible run, and it kind of actually all started last year when the Federal Reserve started providing liquidity to the markets. You can almost tie in exactly where the Federal Reserve started fueling liquidity to Wall Street, and when that happened, silver and gold really started to take off.
AKA when the Fed had to cut 50 basis points the month or 2 months after they didn't cut anything and bond yields surged in their face in response. Was that what you're referring to, Punisher?
Well, a little bit actually, but it really started even so in the summer with the use of the discount window. And so the Federal Reserve was providing liquidity to banks and in over the summer in 2025. And then the repo market broke on September 15th of 2025. And then that's when they started implementing the repo liquidity, which then provides liquidity to more broad financial businesses outside of banks.
Okay, and Punisher, if you can possibly get a little closer so we can hear you a little better, that would be great. And here, as I mentioned, we see gold up 90 bucks on the day. Interesting because silver is down a dollar 13, and I would say in the context of the volatility we've seen, especially in these past couple days, weeks, and in the past month, not entirely surprising with silver surging the way it is, but in either case, we have 48.50 gold, 93.50 silver. And with that said, before we dig into the Fed, Greg, any other thoughts on just the stunning rally we're seeing? I run out of what else to say day after day. I mean, it.
No, no, yeah, the incredible run that gold and silver had is one of the reasons why you need to. Uh, now a core. It's been a core position in people's portfolios, or should have been in people's portfolios over the past couple of years, just because of the trajectory where we're going with no slowdown. And what I mean by trajectory that we're going is that there is nowhere or no one in DC that's going to be reducing the deficits. And what I mean by that is the fiscal deficits. And so our debt will just continue to pile on and pile on. Now, a lot of that, there's going to be some implications to that. And as far as inflation, those things can ebb and flow. And because we kind of still have a free market capitalism society here, people are always trying to find the best deals and prices. So you have kind of like this intertwine of devaluation of the currency, but with the free market also trying to still give you the best prices and the best deals. And so you have this dynamic shift happening between what the government is doing and what the free market is doing.
Yeah, and in there you mentioned how not looking good in terms of cutting government spending, which made it seem odd when I think it was last week. There was an article where Besson was talking about how we need to secure the military and increase spending by 50% over what was already a pretty large number. And he said, well, we found that there's been about $400 billion of direct fraud per year for the last 4 years, although, of course, it began farther back than that, which sure sounds great, although we've seen that the ability to actually do something about that is a little bit lacking. And Greg,
Well, see,
just one more.
that's actually where inflation kind of kicks in because the government has basically been spending about $1 trillion on military since even around the 2020 time period. Because military spending is always near or at the highest expense category for government spending. And so if government spending was staying stable at 1 trillion a year over the past 5 years, but meanwhile, let's say real world inflation over the past 5 years was 50%, that $1 trillion doesn't buy you what it used to 5 years ago. So them raising the defense budget to say 1.5 trillion, they actually just may be trying to keep up with what now it costs to run the military on an inflation adjusted basis.
It's a generous accounting of it. And Greg,
Just
it
to make
just
kind of things a little bit simple and understandable for people who are listening and watching.
yeah, yeah, and just I mean, as these things are happening, probably not an accident of what we see the reflection in the silver price. We're here, spot price in London at 93.85, and Greg, as I know you are aware, quite a bit higher in Shanghai. I get that backed out, converted into dollars at 102.60 an ounce. So fascinating times, which of course we will continue to cover here. And if you're having fun, hit the subscribe button, the notification bell, and we'll keep you posted when you would think at some point that ARB would close. But Greg, in the background of all of this, perhaps you could go back a month or earlier when it started. We've seen unusual activity out of the Fed. They said they're not doing QE, but they're buying treasuries anyway. So can you give people an idea of what is happening, what you think it means, and start there perhaps?
All right, so the issue is that there's a lot of misconception over, especially since we printed trillions years ago, a couple years ago. So what happened was when the inflation peaked at the 9% mark in 2022, the Fed said that they were going to do quantitative tightening. Now, what previously quantitative tightening did, now this is just all kind of new as far as over the past decade or two, was that they were going to sell treasuries back into the market, meaning like they wanted to reduce their supply of treasuries, sell them back onto the market. Well, when in 2022, when the Federal Reserve said that they were going to do quantitative tightening, meaning that they were going to bring down their balance sheet from, I think it peaked around like 8.5 trillion to like 6.5 trillion. So they reduced it by like 2 trillion over the past 4 years. But they didn't sell treasuries into the market, meaning they didn't increase the supply of treasuries. What they ended up doing was if they bought a treasury or a T-bill or a note that yielded them 5% back in 2022, and say that duration was 5%, once it rolled off their balance sheet, they didn't buy more. They just kept rolling them off their balance sheet. And so because of interest rates were elevated in 2022, and when they were buying 3-month T-bills, 6-month T-bills, 1-year notes, 2-year notes, as that time progresses and that bill becomes expired, if they had to spend 100 billion on T-notes that were yielding 5%, and a year goes by, and then as rates have come down, they could actually take the money they got from interest, and they actually kept on buying T-bills and bonds. So they never really did quantitative tightening in a sense where that they were selling new supply or old supply of treasuries into the market. Basically, what was happening was as interest rates came down since the peak of 2023, the maturity of their bonds rolled off their balance sheet, and that would cause their balance sheet to go from 8.5 trillion to like 6.5 trillion today. And then as interest rates went down, because interest rates are anywhere between 3.5% and say like 4.5% today, is that if the Fed had to reinvest those bonds, they can now buy a similar amount, but keep showing the decline of their balance sheet. And that's kind of like why you just pulled up that graph right there, where you can kind of see, you see, it's a steady decline, but there's these upticks and then a decline, upticks and then decline. Now, what happened recently was when the repo market broke on September 15th, the Federal Reserve and Powell signaled that the time for QE was approaching. And then in December of 2025, at their meeting, they announced that QE has begun, meaning that now they're going to be net buyers of US government debt. Now, why would they be doing quantitative easing when the only other times that they've been doing quantitative easing was after the 2020 scenario and only after Lehman Brothers went down in 2008. And so if the Federal Reserve is doing quantitative easing, it's because there's a slowdown in the economy and they're trying to prevent a big downturn in either the credit markets, the economy in general, and that's why they're doing quantitative easing already at this stage.
Okay. And then, Greg, could you touch on what we've seen more recently in the past month in terms of discount window and what they're doing now?
Yeah, so the discount window, so there's the Federal Reserve created, especially since 2020, they've created all these different facilities, and it's all to help financial institutions from banks to financial services to hedge funds to insurance companies. So you have the regular discount window. And what the regular discount window is it's specifically only for banks. So these are like your regional banks, could be JP Morgan, it could be Wells Fargo, it could be Pinnacle Finance, it could be USB. It's like specifically banks. Then you have the overnight repo market and the repo purchase agreements. And what that is you have access to a larger range of people from financial institutions outside of banks. And so the discount window was only for banks, and then the repurchase agreements were for a wide variety of financial institutions. And so when the repo market broke on September 15th, that was actually leading up to what was going on with the collateral issues where you had the First Brands and the auto loan collateral fiasco basically explode, and everyone was taking losses because what happened was everyone thought they owned a piece of paper or a collateral that was worth something, and then all of a sudden what they thought was say worth $1 was actually worth 30 cents. And so the repurchase agreements is where, or the repo market is where all these financial institutions borrow from each other to keep their funding going. And when collateral is questioned, all of a sudden everyone starts hoarding and don't want to lend money because they don't want to get left holding the bag. And then that's actually why you see the repo usage spike. And you're also seeing there's been the secured overnight financing rate. And this is the rate that that financial institutions lend at the Fed. Those were actually spiking last year because people would have rather take a haircut and lend to the Fed than to lend in the actual market because they would be afraid of taking on losses or get left holding the bag.
Yeah, and I guess where does that leave us now? I see a lot of stuff on Twitter, not necessarily all of it is correct. A couple weeks ago, I remember right around New Year's, people were talking about they thought a bank had failed. I think I know where a lot of that came from. It seemed to emanate from an Asian AI video, which has a dubious track record. Actually, I'll say it. I know damn well who's doing it, and the guy's someone that I stay away from, and we'll leave it at that. And that's my thoughts on Asian AI yet. See, there was a lot of people, I think primarily because of that, saying that they thought a bank had failed. Anything that you've seen or could comment on that?
Well, I recently for the Coastal Journal, I published a pretty good analysis on bank earnings. And now the issue is the banks, they don't release their official 10Q statements until the upcoming month. So we only have like these, they filed their earnings, but they're not the full official 10Q report. And in the 10Qs, they're required by law to state if they had to borrow money to stay in business. And so that's in their 10Qs. So what I ended up doing in the banking analysis reports for the Coastal Journal and the Coastal Journal team was I did a dive from the most recent earnings report where I was trying to find out which bank is lending the most to stay functionally in business. And one of the banks that came up, really a red flag, was Wells Fargo. And so Wells Fargo, to me, based on their financials, seem very sketchy. And I'll put out a follow-up when the banks release their official 10Qs where I can pull up the data and see what they were borrowing and funding to stay in business.
Okay, and with all that said, curious what you would expect out of the Fed. I don't know, anywhere from the next 6 months to a year. Obviously, we have Trump saying he's going to bring legal action. I thought it was quite significant that Powell gave a response and he said, bullshit. This is because I didn't lower interest rates fast enough. Like, we're seeing the Central Bank of Poland. They said they were going to increase gold reserves to 30%. They just took it up to 37. I can imagine what foreign counterparties are thinking as they watch that. Add in that Trump's still on schedule to bring in someone who will cut interest rates. Trump said they should be 1% or lower. And again, you've been commenting and writing a lot about how we are seeing economic weakness, which would suggest lower rates, quantitative easing. And it's interesting, we're seeing gold at close to 5,000, silver at $100
So,
before that's happened.
so I'll yeah, I want to add because you're bringing on some good points. Let's think of things very simple. In the overall market, let's just say you really only have three choices for investments. Your first choice is stocks, your second choice is precious metals, and your third choice are bonds. Okay, so you have three options. Now, if the economy is weakening and declining, and really it is, and unemployment rate ended the year higher last year than it was at the start of the year. We know that manufacturing's in a recession. We know that jobs in manufacturing accelerated. We're seeing inflation still stubborn, but a lot of discretionary things versus non-discretionary things, meaning like the goods that people need continue to be in demand, while the things that people don't really need are declining. And so you have this weird mix. And so when you look at, say, those three assets, if everything is weakening and like the Federal Reserve is lowering interest rates, they're already doing QE because of the economy's weakening, and they were lowering interest rates. And then so as an investor, you may say, well, I don't want to own bonds at the interest rates that they're currently at because those yields are too low. So you don't buy bonds. And then if you look at stocks and you look at their overvaluation, stocks really haven't gone up much over the past 6 months or so. And then also over the past 6 months, the AI7 or the Mag 7, they're all down, kind of from the past 6 months. And so people don't want to buy the overvaluation in stocks. So then if I'm not buying stocks and I'm not buying bonds, that only leaves me with one other option. And that one other option is precious metals. And so not only did you have that liquidity surge in the markets, but then people are buying gold and silver because they basically ruled out the two other investments. Now, why do they keep going up? Well, if the Fed is going to do QE and the government's going to stimulate, because Trump did say again that he's thinking about $2,000, tariff checks, which is basically a stimulus check. So we got the government talking about stimulus checks. We got the Fed lowering rates, doing QE because the economy is really weakening. And stocks are overvalued, and I don't want to own stocks if we go into a recession because I don't want to lose 30, 40, 50%. And by the way, some stocks like Netflix, from their high 6 months ago, they're already down 35%. So the overall indexes may go down 20%, but individual stocks like Netflix, you're already seeing it in stocks like some of the AI stocks. I know, for example, Nvidia really hasn't gone up. They're flat over the past 6 months. And so you have like this plateauing decline happening in individual names. And so if we do go in this downturn, you don't want to be in stocks. So then as we're going through a downturn, and if you actually look through 2008 and also at the bursting of the tech bubble, gold and silver both accelerated while we were in a recession. And why was that? It's because no one wanted to buy bonds because interest rates were too low, and no one wanted to buy stocks because they were overvalued until the valuations made sense to start owning stocks. And so during this frame where the economy is kind of maybe on the edge of the cliff here from falling over, and then when it does fall over, you still only leave investors with one choice for gold and silver as an investment. And so we're seeing all that because what happens when the economy is in a recession? Well, they devalue the currency. They flood the markets with money. They flood the markets with cheap credit. And so all that does is increase the money supply and then keeps on boosting the price of gold and silver up higher.
Yeah, and Greg, I will agree with everything you said there, yet still re-raise you because if that's possible, you'll see, you can tell me if I'm bluffing here, but everything you just mentioned, that's also in an environment where now Wall Street has something called the debasement trade. So basically, we have a marketing title for people buying gold and silver. I mean, you have even Mohammed El-Arian getting worried and talking about gold and silver. Can't imagine how distressed he must be about the lack of independence to the Fed that never existed, at least since Ronald Reagan called Paul Volcker into his office about 45 years ago, sat there and said nothing while James Baker told him that he wasn't going to raise interest rates until after the election. So technically, Reagan did not tell Volcker what to do with interest rates. He let James Baker do it for him. And also, Greg, take a look at this one. I've not seen Carol Merks before, although I agree with what he's saying here. I mean, there's a lot of reasons why, if you think, all right, 10 years from now, is the gold price the same, higher, or lower than it is today? I think this is everything else. We could bonds, Fed, Treasury, this and that. Yet, you can read this one and we can get your comment. Gold's above 4,700 and he thinks it's going much higher. In the 28 largest countries, there's 78.2 trillion worth of investment grade bonds outstanding. The chart shows the current market value of the debt. Total value of the gold is 32.8 trillion. And here's the key part. At some point, lenders will start to question whether the money they get back will still have real purchasing power. We already saw a preview of what that looks like today in Japan, where yields are jumping sharply. We'll get Scott Besson's commentary on that, which includes the markets are going down because, but I mean, I think he captures here what's at the heart of it, that if your money is sitting in bonds, and Bessent also was talking about how we need to get everything reshored, which I think is fair enough. Just the bondholders are on track to get pummeled in historic fashion here. You laid it out earlier in the call, but anything you'd like to comment on this one?
Yeah, listen, I've been running the numbers for the past 5 years before the gold trade got popular. I've been on your show. We've talked about the numbers rising. I think maybe the first time that I came on, I think the national debt was like under 30 trillion and now it's like 38 trillion. So, I think the misconception is I am an advocate. I would tell people to own gold and silver, not to promise prices, but to have it as a allocation. Yeah, 38.6 trillion on the debt, but have an allocation in your overall portfolio. If you're wealthy enough to have a portfolio, gold and silver needs to be in there. I don't like to put prices on things because, let's say if the Federal Reserve for some reason had to raise interest rates out of nowhere, And then gold and silver experienced a downturn with other asset prices because, like in 2022, when the Fed raised interest rates, literally every asset went down in 2022. So if you own assets in 2022, you ended up being down, 20+% in pretty much every asset class: real estate, bonds, stocks, gold, and silver. So there was no escape from the Fed raising the interest rates during that 2022 period. Now, they're not planning on raising any rates as of right now anytime soon. But the issue is they may not be raising rates, but with the bond market, with the current rates hovering around four to say high fours, let's just say 5%, is that affects the real economy. So the Fed doesn't necessarily need to raise the short-term borrowing rates because for you and me, that does nothing for like me trying to buy a house for a mortgage because a 30-year mortgage is based on the long end of the bond curve. And so with interest rates rising or staying stubbornly in this four range, it keeps real spending in the economy limited. And so, you could actually have like the Fed say lower short-term borrowing interest rates, but if the long end of the bond curve doesn't go lower, that doesn't really help you and me and most of the people listening and watching this. Because if I want to go buy a house and I need to buy a house and I need interest rates below 5%, well, if interest rates are at 6% because the long end of the bond curve is where it's at today, well, that doesn't help me stimulate me buying a house. And so it doesn't really help the economy grow. Now, it could cause some more speculation on the short end. Lowering interest rates may cause more speculation. But again, that doesn't help what real economy. It doesn't help businesses. Like, if interest rates stay at this level and you want to start a business and you need a loan, well, interest rates are going to be higher for that loan. And that's because everything is based on the longer end of the curve and not short-term borrowing. And so that's also part of the dynamic that we're seeing in the markets is that short-term rates kind of keep things elevated as far as asset prices go, but it's really to get the real economy going, you're not really going to be stimulating demand. I think also when you look at some of the data that came through, when the interest rates were declining before this week's little spike, that it wasn't really stimulating any real demand in the economy, meaning that the current rates aren't really doing much. And I think there's also, I view the way markets work with inflation differently than what everyone else does because they're so keen on interest rates. And what I mean by that, when you actually look at interest rates going back to like the Paul Volcker era, and Paul Volcker had to raise the interest rates to 20%, you would think like, oh, why wasn't like he was only raising rates in line with inflation. And so if inflation was 10, he had the rates at 10. And then if inflation went to 12, he had interest rates at 12. So meaning like he was just going with the level of rate change of inflation. He didn't raise it high enough to be like, well, if inflation's 10%, let me have interest rates at 20 or 30%. He was just going with the rate of inflation. And that's really what the Federal Reserve does. And why is that? Because if you actually look at what happens first, the raising of the interest rates or inflation, it's always inflation. Well, if inflation happens first before the interest rates rise, well, how does inflation rise? Well, it rises when you increase the money supply. So money supply rises, that gets trickled into the economy. You have more money chasing fewer goods, causes prices to rise. Then the Fed just comes in and raises the interest rates. But that's not stopping inflation. And so how does inflation resolve itself? Well, it resolves itself by higher prices, meaning the cure for inflation is inflation. And we're starting to see that in markets now, where basically things are just so expensive, it starts to implode on each other or on itself. So for example, we're talking about, the long-term debt. And so what are we seeing in the economy? Well, we're seeing that people may still have jobs, but they're living at home longer. So if the average, I don't know the exact age, but like let's say 5 years ago, the average person moving out was like 28. Now it's like 38. And so they're still working, but they can't afford to live, so they're staying at home longer. And so and what I'm trying to say is the debt and inflation may not actually just lead to higher prices, but it just leads to more of a collapse of our quality of life. And I actually try and relay that in reporting at the Coastal Journal, because it's quality of life that deteriorates. And so, for example, the CPI metric that we get those inflation reports, they're in like we'll say 3% range, which technically isn't that bad. Well, that's because they use things like TVs and cell phones. Well, why do electronic prices like TVs constantly go down in price? Well, it's because you have economies of scale, better technology, and so those prices keep going down lower, lower, and lower. But how is it we're having electronic devices fall in prices, but we're having people living at home longer and longer and longer, which then delays things like marriage, having kids. Maybe people get married and decide not to have kids. And so the quality of life and the American dream is what's collapsing because you can't afford. They can still afford to live, but they can't afford what we used to have in America. And so that's the real message, and it's not going to stop. And so this is what I keep on warning about, and why gold and silver now is that the jig is up. Because a lot of times you had all these new politicians. When Trump ran in 2016, he ran on, squaring away our deficits. I think literally when he became president in 2016, I think the national debt was under 20,000. So let's just say it was like 20 trillion. I'm sorry.
Trillionaire,
Trillion, yeah,
Punisher.
I
Come
know.
on, man.
So if it
Don't
was
let him
8
off the hook
trillion,
that
I
easy.
forgot
Come
what it
on.
was. I think it was under 20 trillion, and we're about to approach 40 trillion, right? So basically the national debt has basically doubled, or if not more than doubled, since President Trump was elected back in 2016. And so what I'm trying to say is no politician is going, you have the data right there?
I do, Punisher.
All right, what was it? Was I right?
Under 20
Yeah.
trillion, not
Yep.
under 20,000, but under 20 trillion. So Punisher punishes again.
Thank you. So it was under 20 trillion when Trump was president. Now we're approaching 40 trillion. So, and that was only 10 years ago. So guess what? 10 years from now, let's go for another double. So that means that 10 years from now, the national debt's going to go from 40 trillion to 80 trillion. And that's just math because we're not bringing in more revenue. And no politician is going to be raising taxes on people. So if you're a downturn in markets, gold and silver, or there's an event like 2020, gold and silver will go down in price. But that is going to be a great buying opportunity for people who don't own enough and need to add gold and silver to their portfolios. And so the trajectory on where we're going is more, I would look at it, not necessarily, it is a decline in purchasing power, but to me, it's more of a decline of the American dream and the American quality of life. Because in markets, you will find ways to survive. It just may not be the way that we used to be doing things.
Yeah, I know what you mean, Punisher. I forget where I heard this, but someone was mentioning, I think it may have been Charlie Kirk, as I've been researching and learning about him and bizarre circumstances around what happened on September 10th. Of course, a very tragic thing. And side note, sad to see that when someone gets killed now, there's half the country celebrates. But that aside, I think what he was mentioning was that this is the first generation that is under worse living standards than their parents. And it's like, when you're sitting there living through it year after year, it really hit me where, yeah, I think you look at what's happening. It doesn't seem like things are going easier, and certainly the inflation, we've been feeling that. Punisher, you also mentioned that the debt was under 20 trillion back then, and I remember around when Trump was saying that he was going to, start repaying the debt by giving out $2,000 checks to everyone. I thought that sounded odd and reminded me. Sure enough, Donald Trump back in 2016 said he would pay off the nation's 19 trillion debt over a period of 8 years. So we're 8 years later. Maybe he meant over his 8 years, but it doesn't look like that's going to happen. So again, worth taking these with a grain of salt. Something else you mentioned earlier, you said about having gold or silver exposure. I'm not a financial advisor. I'm also talking to a lot of different people, and I think everyone's situation is an important part of your trading decisions. Yet, with all that said, and I'm not asking you to give legal financial advice here either, but you are an advisor, and just in general terms, I guess I've come to the statement if you had 10 or 20% of your portfolio of your long-term bucket in gold or silver, given what's going on in the world, if for nothing else other than diversification, would you say it's kind of hard to argue that that is going to be a bad decision that's going to get you clobbered?
No, absolutely not. I mean, again, the only thing that would be a clobber would be if we go, when you think about maybe over the next 5 years of a cycle, it really depends. I think this year will make a huge difference on the outcome of where the things are going to be in the economy, where we're either going to find out if where interest rates are today are the, say, low in the cycle for rate cuts, or that they need to get lowered because the economy and we have a credit crunch like we have had previously. And the reason why I still talk about credit crunches and banking is because of the use of the repo market, the use of the discount window. There's a bad apple or bad apples out there. And where, to me, if that were to be known, that would put pressure on financial assets as people would be in a panic on a credit crunch, where short term all assets would get crushed at that point.
Okay, and in terms of that, would you say that, especially, what is it, 2 years since we saw that day where the yen carry trade blew up and I think the Nikkei was down 12%, would that be the kind of event that could trigger some of those conditions you just referenced? And let me play here. This is our own Treasury Secretary Scott Bessent, who said that we could afford to increase military 50% spending, 50% as long as we cut some of the budget. Although, Greg, do you remember your conditional theorem? You know, the probability of A based on B, but it's
Right.
kind of like Naked Gun. Well, there's a 50-50 shot of him living, but only a 10% chance of that. Anyway, let's go back to Scotty here and see what he says, and then Punisher, you can punish this one.
I believe the markets are going down because the Japanese bond market had a 6 standard deviation move.
Sorry, but I need to review that one. Just interesting. Now, I understand he was probably mid-sentence, but the phrase, I believe markets are going down. I don't think he meant market catastrophe, but that they are going down now, yet still in a era of things that don't look good internationally.
I believe the markets are going down because the Japanese bond market had a 6 standard deviation move for the past 2 days. That would be in their 10-year bonds. I've been in touch with my economic counterparts in Japan and urged them to take the necessary measures to stabilize their bond market, but that's spilling all over into all bond markets. German yields are up, French yields are up, U.S. yields are up, again, it's mostly the Japanese bond market, got nothing to do with Greenland. I believe the markets are going
Let's
down
pause
because the
Scott
Japanese
there.
bond market.
And basically, I'll pull up the yen chart, but again, not just the yen yet. We're seeing things happen. Here is back in November of last year, we've gone from about 150, 175 basis points up to 230. So about a 50 basis point move. We are starting to see movement in the 10-year back up to 427 in the US. Anything you could add to what he's saying there, the conditions that we are seeing now in the bond market, which are kind of what you just described for the last half hour?
Uh, I think media likes to always point to things to explain daily moves. And because we're in this 24-hour news cycle, that people's attention spans are very limited and can't see the big picture. And that's one of the reasons why I don't really harp too much on headlines, is because that's more of people are looking for direct answers for something that's happening on maybe even a daily basis. And as I'm a long-term investor, work with people who are long-term investors, is that, daily and even weekly moves or monthly moves are, things to consider and look at, but I look at more of where the trends are going and where things are going. Because, for example, if you had a chart and you had a bunch of spikes, 5% decline, 3% uptrend, then 5% decline and 3% uptrend, your trend would be like this spiky thing, but the trend line is kind of going lower because you keep on having these volatility moves of up 5, down 3, up 5, down 10, up 10, down 5. And so it's like, well, where is the trend? Because that's just a bunch of people and algorithms trading on a daily and weekly basis. But it's like, where is the trend? Where is the value? And the other thing is, people are so keen on why this is happening, why that is happening. People want answers, and people want to know why things are happening. And it's very hard to get any type of conclusion on a daily basis or even weekly basis. But going back to Japan, their interest rates are soaring because they're the lowest out of all the G7 nations. Their interest rates are the lowest out of any of the G7 nations. And so, yeah, their interest rates should be going up because they're the lowest compared to any other G7 nation. So, like, why would Japan and their investors want to lock in any type of yield at 2%, 3%, say on a 10-year basis, when they're getting over 4% in US, they're getting over 4% in the UK, they're getting near 4% in, or like high threes in like Italy and Spain. So there's a higher interest rate. And so that's why the yen is selling off, is because the interest rates aren't high enough to stabilize the yen. And so they're selling yen in the market to get other currencies, whether it's the euro, whether it's the pound, whether it's the dollar, because they can get either better rate of returns or better assets when what they have in Japan.
Well, going to be interesting to see how that has the ripple effects, and perhaps that comment that that gentleman shared on the Twitter one we looked at, where he talked about money leaving the bond market. I wouldn't say you can conclusively say that the bond vigilantes are exiting now, although maybe can't entirely rule that out either. Punisher, one last note and then one final question before we let you run, and thank you again for your time here. I mentioned how silver is up about just under 100% since November 21st. And interesting, because if you look at the dollar index, here you see on the 20, that's October. If you go to the 21st, or there's the 20th. So I guess the dollar index down slightly, but I mean, you can see a lot of this has happened. Well, the dollar index has stayed.
You bring up a great chart right there. So that decline on September 15th is the day the repo market broke. That's actually where the Dixie bottomed, on September 15th. That's actually right after, the week after Powell came out on his conference and said there has been material change in markets, and why the dollar bottomed on the 15th and why it's now rising since that moment in time is because if there's a collateral problem and a bank solvency issue, that means there's a liquidity problem. And all the banks settle their liquidity issues in dollars. And so that goes for all banks. And so if there's a dollar shortage, or people are hoarding dollars because they're worried of collateral issues, insolvency issues in banks, this could be a warning sign that I'm noticing now in markets. So I think that September 15th price in the Dixie or the dollar index is something to be paying very close attention to. And actually, if you pull up, if you had easy time to pull up actually where the repurchase agreement chart, if you have that available.
This one or the one that I had up from your column before?
The other repo one. That's the discount window.
Give me a second on that one, but I will get that right and continue, please.
Yeah, so now the whole reason tying this all together is that if there's a collateral issue in the markets, meaning that if collateral everyone thought was worth $1 is now worth 50 cents, no one wants to get left holding the bag. And that also means that I don't want to lend to you, which now means that my dollars I'm hoarding are even more valuable. So the price of the dollar actually rises because people start actually, now this is very short term. I'm not saying that the dollar is an investment. I'm telling you how markets function. And so the dollar is showing some strength right now, not like massive strength, but it's holding steady and slightly grinding higher since that September 15th day that we saw break in the repo markets. And that actually that month is actually when the Federal Reserve lowered the interest rates in September 15th. So if you actually look at it, so if you look on that chart at the very beginning, that first spike, that was September 15th. That little guy right there, that was September 15th. That was the first sign that we saw the repo market show its weakness. And so the issue here is if this is an issue in markets with collateral, that the dollar is showing some strength actually because of the issues that are going on. So it's things to pay attention to. And like I said, that September 15 level is very important right now.
Greg, one other quick question of the spike we see here. I know there's a lot of things that happen each quarter end. How much of that is due to quarter end accounting versus what you've been describing throughout our call today?
So the reason why they mention quarter ending is because banks need to do a lot of balancing in their finances at quarter end. And so the issue now is, why are banks or financials businesses going to the Fed at the quarter end? It's because they need to get their balance sheet squared away. And so you see usually a huge spike towards the quarter end. So the question now is, well, why are they going to the Fed? Because they need dollars. And the only one providing them the dollars is the Federal Reserve, because their counterparties are not willing to give them dollars. And so you have this dynamic right now where there is dollar stress in the system, where people are skeptical because as much as we love assets and that assets can rise in value, you know, everyone loves the cold hard cash in their hand at the end of the day.
You mean the cold hard silver in your hand at the end of the day? I'm assuming, I mean, that's really what cash could be thought of. Punisher, one last quick one. I know I promised to get you out before the top of the hour, so I know that you do a lot of modeling, active in the stocks. Obviously, we have a lot of mining stock investors, and I know a lot of people have been saying, well, are we too late? You know, there's some people who say, how come the miners haven't moved more yet? And there has been a lot of movement, but in the past week, I've heard both Rick Rule and Tavi Costa say that they feel the miners are cheaper now than they were at $50 silver or half this gold price. Any quick comment on that? Again, not legal financial advice, but
No, absolutely. So, you know, the miners from gold and silver miners, they're all going to make a ton of money and report a ton of money when they report earnings this upcoming earnings season, which is coming up over the next 2 to 3 weeks. And so they're going to report massive profit margins or record profit margins, record cash flows. You know, I'm sure companies like Newmont and Barrick Gold will announce like big buyback, you know, programs. The issue is now is do the price of gold and silver stay where they're at, or do we have a overall market correction where the price of gold and silver go down, and that may hurt their price short term? But even let's say on a very crazy scenario, gold falls back down to $4,000 an ounce and silver pulls back, and let's say a crazy scenario where it even falls back down to $50 an ounce, the mining company are still making a ton of money, and therefore their profit margins, their cash flows are still going to do really well this year. It just depends on that volatility at what price you own them. And so it's not that this is always the conundrum, like the tech bubble. And let's focus, just because everyone's very familiar with that. Amazon, you could have owned Amazon at the peak of the tech bubble. Amazon, look where it is today. It's one of the, gone up massively. But you also went through an 80% drawdown at the bursting of the tech bubble. And so my point is that you can still own good companies, but the value of them can fluctuate. And if you're a long-term investor, it's about managing that exposure so that if you do have that downturn, it doesn't, make you go bankrupt, or, make sure you're managing those losses, meaning you're not over leveraged to that sector. Because I remember when I was on your show and we were talking, literally, it was December, I think, in 23, when we were talking about the Federal Reserve, where they announced that they were done raising the interest rates. And that was actually with the low of the market and the low of gold and silver. And I said, I'd rather hold gold miners like Newmont paying me over a 4% dividend back then. And I said, I'd rather get paid to hold on to Newmont to wait for the price of gold to rise, because I knew the price of gold would rise. And so I got paid my dividend from Newmont waiting for the price of gold to rise. And then when it did, Newmont skyrocketed. And so as an investor, you have to understand why you own stocks and why you own companies. Things like dividends, things like buybacks, things like earnings growth. And so can Newmont, if the price of gold does fall back to $4,000, could the price of Newmont fall 15%, 20%? Absolutely. And that would be a great buying opportunity for people. But knowing like, stocks aren't going to go down 20% because they're about to report record earnings. Well, yes, that is true, but that doesn't help us what happens, maybe in Q2, Q3, and Q4 later this year. So
Makes a lot of sense, Punisher. And yeah, a great point you had in there where it's like, well, what happens to the miners if gold or silver in particular goes down to 70 or back to $50? And yeah, I mean, you'd certainly see that reflected. Although, if you go back a year ago and you told the producing miners, hey, we might have a $50 silver price, they would have been like, whoa, where do we? And I think we'll see that recognized as earnings come in quarter after quarter. I mean, I don't want to jump ahead of the fourth quarter earnings, but Greg, we're already two-thirds of the way through January. I mean, if prices stayed at these levels, it's like, man, what is the first quarter going to look like?
Right. Well, exactly. So you have to remember that when the miners report their earnings coming up over the next couple of weeks, that they're going to be reporting on where the price of silver and gold was from October 1st to December 31st, right? And so if they still report record earnings
We're still going.
okay, if you still revert to where prices were in Q4 of 2025, the miners are still going to have a great year, but their price of owning them may fluctuate. And so for people who don't own miners and silvers, a strategy would be to say, like, what I personally do is, if there's a company that I want to buy, but I don't want to pay market price for, is that I sell a put option. And so I'm like, okay, I want to own this company, but I don't want to pay the market price today. What I'll do is I'll go out on say the next 6 to 12 months, and I say, I'm willing to own this company at a 20% discount, I'll go into the options market and I'll sell a put. So if something is $100 and I'm like, I'm willing to buy this at 80, which is a 20% discount, I will sell a put option for 80. I'll collect a premium today and I'll get paid today without even owning the company. And I'm waiting for the price to hit 80 to own it at 80. Now, the thing is, if it never hits 80, I'll be able to collect a premium. And so I still made money. And that allows me to avoid buying today. That 20% correction comes, and then I lost 20% of my value. So it's like, for investors who are like, well, I missed the run in gold and silver, now they went parabolic. I don't want that risk of that 20% drawdown, and that's something that people can consider. And that's what I do and how I do all my, stock investing. And when I find a company that I want to own, is that I assign a value to it, and I'll sell that put option based on the value that I think I want to own it at.
It's a great point, Punisher. I remember looking into that a couple of years ago, and I'm glad you reminded me of that. In fact, I will be calling Punisher in the near future because that's something I'd love to talk more with you about. Maybe we'll report back, but that's why I'm darn grateful that Punisher is at the Golden Coast on Twitter. One Coastal Journal is the handle here. And of course, even better is getting access to your fantastic research. There on December 18th, that's when you were first reporting what we looked at with those charts. So if you go to coastaljournal.substack.com, that's back on December 18th. Although, Punisher, you certainly punished quite a bit since then. I love that you work in some movie quotes and rock. Every article we get a good like movie or music reference. Certainly a lot of Big Short, and for the option fans out there, Punisher punishes those too. So again, coastaljournal.substack.com. Also in the description field below. And Punisher, I just appreciate you being here and sharing everything that you did. It's really helpful, especially at this time.
No, absolutely. I'm glad that I can even elaborate a little bit more than what we publish at the Coastal Journal. It's a great way of me being able to communicate to people that on your channel, as well as whoever else is sharing and wanting to learn, different strategies, what the numbers really mean. There's so much misinformation, people pumping their individual holdings. And what I try and do is give people the tools so that they can make better informed decisions on their investments, because my whole goal is to provide information and knowledge so that that benefits everyone. And so I don't want to say, oh, only buy, this company or only buy this asset, because, as we wrapping up full circle, as the government's going to be increasing the deficit by double in the next 10 years to 80 trillion, investors are going to be wanting the best Austrian with a updated flair and twist to 21st century principles on investments going forward.
Well, I sure appreciate that. I enjoy very much getting your journal directly into my inbox, one of the advantages of signing up at the Coastal Journal. And just in closing, one quick note, would like to thank First Majestic Silver, who did bring us today's video. Whoops, and I got, what happened to my tab that we had up there? And certainly for First Majestic, I might add, good times when, a perfect example of if you had told them a year ago that we'd get $50 silver prices, especially after they did that deal with Gatos. I mean, Greg, that's like all-time legendary timing for a deal by another silver producer right as the price soars not only to 50, but then goes for two up to 100. So thank you to First Majestic for sponsoring today's show. And they did have their production numbers out last week, which we had a short video on. Included record quarterly silver production, increased silver equivalent production. They're continuing their exploration. They have some new targets they're moving forward. So certainly quite a position to be in with everything that Greg just described here. So thanks again for doing this. And yeah, we'll talk some options soon and have to do this again. But I appreciate you being here, and hopefully this was helpful to everyone watching at home.